Suppose that your friend owns an ice cream shop and they need money to expand their business. They decide that his shop is worth $10,000 and offer you 1,000 shares of his company for $1 each. And in return, you will own 10% of his shop. You then decide that this is a good investment as summer is approaching and agree to the deal. A week later, sales skyrocket and the public decides that his shop is now worth $15,000. Assuming no additional shares were added, the worth of the ice cream shop is now 150% of its initial valuation. So your 1,000 shares or 10% stake in the company is now worth $1,500. This is known as stock price appreciation, and you would have made a profit of $500 from your initial investment of $1,000 or a 50% increase. Now assume that your friend wanted to keep his full ownership in their company, so they asked to borrow $1,000 from you and promised to return it back after 5 years. In return, they offer to pay you 10% of the original loan, or $100, every year throughout the 5-year period as a fixed, non-negotiable rate. After the 5-year period is up, they will then repay your original investment of $1,000. You agree, and after 5 years, the total came out to be $1,500. Also a 50% increase on your initial investment. The first scenario describes a very simplified version of a stock investment, while the second scenario outlines the basics of a bond contract. Buying a stock is equivalent to owning a small percentage of a company. Investors who purchase a company's stocks hope that the firm will do well and thus raise the overall worth of their investment through price appreciation, dividend payments, and buybacks. Purchasing bonds is equivalent to loaning money to an organization in hopes of gradually earning a simple interest payment over a designated period of time. Both stocks and bonds are a viable investment option, but depending on the investor's objectives and risk tolerance, they may choose to focus their money on a specific side of them. So, which one should you focus your investment on? To evaluate the appropriateness of stocks versus bonds in your portfolio, you must look at the two through the lens of risk and reward. When you invest in a corporation, you would have subjected yourselves to the inner workings of the company's financial state, workplace culture, and its general well-being now have a direct influence on your ability to generate a return on your investment. Strong qualities that investors look for before investing include a viable operating model overseen by a competent management team, upward growth potential with a track record of stable revenue and asset expansion, reasonable amounts of debt and risk factors, a strong presence in their market relative to competitors, and a reasonable stock company valuation. These qualities maximize the chances that your shares will appreciate in value and bond payments can be regularly paid out. However, companies that do poorly may cause investors to lose faith in their organization, result in a sell-off of the company's stocks and causing your investment to lose value. A company with poor financial health may also be unable to pay bond investors back, resulting in a bond default. However, it is generally agreed that stocks are a higher risk investment than bonds due to the lack of a guarantee. There is really nothing stopping the share price from dropping below your purchasing price and thus your investment to lose value past your original invested amount. Since the price per share of a company is derived from how much investors believe the company is worth, you are essentially judging that the share price is currently undervalued and that other investors also see the company as undervalued and are willing to buy your shares at a higher price. There are of course tools such as income statements, analyst ratings, and PE ratios that assist you in making more plausible decisions. But after all, the market is volatile, and one poor news coverage may send the share price tumbling down along with your portfolio. Bonds, on the other hand, carry a guarantee that the principal amount or the original loan will be paid back at the maturity date. Investors also receive the fixed rate payments, also known as coupon payments, according to the coupon rate listed in the bond contract. Unlike stocks, unless a bond issuer defaults, you cannot technically lose your original investment as it is paid back along with your coupon investments at the end of the contract. In addition, bonds are less affected by the volatility of the market and investor sentiment, as the only thing that long-term bondholders theoretically need to worry about is whether or not the company has the financial health and capabilities to finance coupon payments and the principal investment. There is always the risk of a company defaulting if they are unable to generate the cash flow needed to pay for it. However, the average rate of investment-grade bond default is extremely low at 0.4%, and you can always choose to invest in high-rated bonds, such as treasury bonds with lower yields, but also a near-zero risk of defaultation. Additionally, in the event of a bankruptcy, bondholders are paid before shareholders, so even in the face of a collapse, bondholders are more likely to receive full remuneration compared to shareholders. Despite the riskiness of stock investing, stocks have historically yielded a higher annual return of 10% compared to long-term bonds with an average annual rate of only 5 to 6%. Although market volatility can easily result in an investor losing double percentage digits of their portfolio over a poor stock investment, it can also create massive gains. Bonds come with the upside of having a safe, fixed-rate interest payment, but the downsides of being unable to scale these payments past their fixed rates. This makes bond investment extremely resistant to changes in the markets, which minimizes losses, but also minimizes potential yields. Stocks offer investors a more risky investing option by granting exposure to their investor sentiment within the stock market, allowing the general public to collectively influence share price instead of a predetermined coupon rate in a bond contract. Stock market investors also have an easier time capitalizing on market trends and have the flexibility of getting in and out of the market quickly, allowing for fast opportunities to generate profit even within the same day. However, this also makes stock investors prone to making emotional decisions and throwing risk management out the door. This graph illustrates what $1 invested in 1965 would result in by 2014. The stability of bonds is clearly outlined through the slow but steady growth in price appreciation. However, stocks take a more volatile approach, with certain years even yielding a negative return, but nonetheless return 367% more than annualized bonds over the course of 49 years. Although stocks carry significantly more risk, the potential gains are also amplified several times. The way you structure your investment portfolio largely depends on your experience and your risk tolerance. In general, stocks carry more risk than bonds because of the amplified chance to net a negative return if the share price drops below your purchasing price. A bond contract, however, guarantees that your initial investment will be repaid by the maturity date while providing consistent coupon payments. Stock investors also shoulder the increased risk of subjecting themselves to the volatility of the markets compared to the fixed coupon rate. And under a situation that a company does declare bankruptcy, bondholders also receive priority payments while shareholders are paid last. However, due to the overall higher returns of the stock markets, many younger investors are willing to shoulder the increased risk and proceed with stock investments. After all, stocks enjoy the benefit and downfall of constant price fluctuations that can result in evident returns in a shorter period of time. Young people who are decades away from retirement are particularly fond of this option as they have the time to recoup losses during bear markets compared to a middle-aged person who plans to retire soon. Historically, the stock market has proven that no matter how bad a bear market is, it always bounces back. The problem lies on whether one has the patience and time to see it recover. If a soon-to-be retired person invests right in a bear market, they may see a notable drop in their portfolio value and not see it recover before they retire. Thus, many elderly invest primarily in bonds that have a more consistent rate of positive growth, while a young person in their 20s can simply wait for the market to recover. So, when should bonds be in your portfolio? The general rule of thumb is to invest in 180% of your portfolio in stocks and the rest in bonds, which means if you're 48 years old, you should aim to have a portfolio consisting of 52% in stocks and 48% in bonds. However, due to the varying financial situations and risk tolerances, it is advised that you consult your financial advisor before making these decisions. So, should you invest in growth or dividend stocks? Find out more in this video.